Hi, I'm Scott Purves, and I'm making this video in response to the news that came out last week on February 11th, 2025 about the California FAIR Plan's assessment of insurance companies and how that's going to affect both commercial and residential policyholders in the state of California in the coming year. The California FAIR Plan is the insurance company of last resort. I made a long video about the current marketplace and how the FAIR Plan works within that, but essentially the FAIR Plan insures all of the high-risk commercial and residential properties in California that traditional insurance companies won't insure. Over the last couple of years, they have started to insure a lot more properties as insurance companies have withdrawn from higher risk areas. The bottom line is the FAIR Plan is now insuring a lot more properties in California than it has before, which means they have a lot of higher risk properties on their books. And then we had the big fires in January of 2025, well before our traditional fire season, and that's affected the FAIR Plan. So last week, the FAIR Plan went to the Department of Insurance and requested an assessment. How does an assessment work? So the insurance companies in California back up the FAIR Plan. So if the FAIR Plan gets dangerously close to or runs out of money, they can assess the insurance companies. The number that was approved by the Department of Insurance on February 11th was $1 billion. Which is spread out proportionately amongst all the insurance companies who insure properties in California. So if a company insures 20% of the market and it's $1 billion assessment, they get a $200 million assessment. How that affects policyholders is that assessment, let's say carrier A has a $200 million assessment, they will then distribute that proportionately amongst their policyholders. So I want to talk about what we know, what we don't know, and then what, if anything, you can do about it as a policyholder. And I'm thinking primarily about homeowners policyholders in California. What we know the Department of Insurance has approved this $1 billion assessment. We don't know if that's going to be the final number, if it'll be lower or higher. We do know that after the fires in January, the FAIR Plan has reported over $4 billion between paid claims and reserves they've set aside to pay the rest of the claims as those claims unfold. And they're reporting that by July of 2025, that their cash position will be somewhere in the neighborhood of $400 million. That's important because with only $400 million in the bank, they're just entering what we think of as the traditional fire season. That's why they're doing this assessment at this time. Under current legislation, the assessments that go to the insurance companies, only half of that assessment can be passed on to policyholders. So again, we don't know how much the eventual total will be. We know about half of it will be passed on to policyholders. Another thing we don't know is in what form that will be to the policyholders. It will likely be a one-time assessment to the policyholders. This is the first time in over 30 years this has happened, so it could be different than it happened many, many years ago. It could be in the form of rate increases. In fact, State Farm last week already applied for an emergency temporary rate increase of 22%. If that gets approved, because they're one of the biggest property carriers in California, other carriers would likely follow suit, although at this moment, none of them have yet. The other thing that we don't know for policyholders is exactly what that dollar amount will be. That news will come. So I don't want to just scare everybody, but I think policyholders ought to have the information at their fingertips so that you know that something is coming. It will be either a one-time assessment or it could be in the form of rate increases on your next renewal bill. If I had to venture a guess as to what it would be, I would guess that it would be in the form of rate increases, because rate increases would then be there in additional years. I would assume the insurance companies would prefer that. So what can you do? Well, there's really only two things that I can think of that you can do at this point. One is to stay informed. We'll keep sending out information. I'll link to a couple of articles that just came out as well in this video so you can read more and get more information and be prepared. We don't know when these things are coming, but we will definitely let you know as soon as we have that information so you can be prepared for it, and we'll be able to help you through that process. The other thing that you can do, and I'm speaking to homeowners primarily, is make sure that you have your auto and your home with the same carrier, whether it's with us or anyone else. That's the best way for you to save money on both your home and auto insurance. We'll be reaching out to all of our clients where we insure your home but not your auto to try and put the two together, because you're going to save somewhere in the neighborhood of 15 to 20% on both policies by putting them together. I hope this information is helpful. I hope I didn't just scare you with nothing to do about it, but we want to get this information into your hands because we haven't seen this in 30 years and you need to be prepared for what's coming. Thank you, and please reach out to us if you have any questions and we can help you out.